Welcome back, traders and investors. We have David Hornik on the line. He is an investor at August Capital and author of VentureBlog.com. He's also a lecturer at Harvard Law School, where he teaches entrepreneurship and venture capital, and previously lectured at Stanford, where he taught intellectual property. David, how you doing on this Tuesday morning?
I'm doing all right, but now I have to sound a lot more erudite than I think I'm going to be able to muster.
That's okay. I mean, we definitely respect the second and third best colleges in the nation. Being from Michigan, you know where I was going at with this one. But tell us about your site, VentureBlog.com.
VentureBlog. Well, VentureBlog is it's actually the very first blog about venture capital. I started it with a couple of colleagues back more than 10 years ago. And at the time, there was no one really talking about the venture capital industry. They were just, in fact, people sort of thought that the venture capital was this black box, and investors thought that was the way they wanted to keep it. But as I looked at it, I thought, there was no particular advantage. It wasn't like I had some grand secret to the venture business. I actually thought that there'd be some advantage in having a conversation with entrepreneurs to let them know the sorts of things that I was looking for. And so I started VentureBlog to sort of create this opportunity for entrepreneurs to understand that these are the sorts of things that venture capitalists are interested in. These are the ways that we think about technology, et cetera. And I think in the end that has been pretty valuable, both to me to have the opportunity to sort of articulate the things that were interesting to me, but also to entrepreneurs to have a better understanding of the sorts of things that VCs are looking for.
Okay, so in your 13 years, you think you've looked at 5,000 executive summaries directly from the founders, and I don't know if this was initially you didn't fund a single one of them. What are you looking for when you're looking at these executive these executive summaries? What are you looking for to make you invest, and then what is an automatic turnoff?
Yeah, I guess the numbers are something like I probably see 1,000 executive summaries in any given year. And so, I've been in the venture business for about 14 years now. So, 14,000 executive summaries that have come into my inbox over time. I probably fund a company or two a year. So we'll even say two. That's 28 of those 14,000. So obviously the odds are quite bad that you're going to get funded. So I've written about this on VentureBlog. I mean, I think one of the challenges for entrepreneurs is how do you get to VCs in a way that makes you compelling, that gets the venture investor to pay attention. And the number one way to do that is to get introduced to that venture capitalist through someone they know. So what I have said is that over all of this time, over looking at these thousands of executive summaries, and in fact, I have, if you email me an executive summary, I will and have looked at it. But of over the 14 years that I've been looking at these things, I have not once funded a company that didn't come to me through an introduction or through someone I already knew. And so, the way that you get to a venture capitalist is to say, hey, friend of venture capitalist, come understand what I'm doing, and then tell David Hornik that what I'm doing is exciting. And the number one turnoff is someone who hasn't taken the time, doesn't have sort of the wherewithal to find that introduction.
Okay, so they get past the introduction, you get the executive summary, you're looking it over. What are you looking for? Is it the idea? Is it the business plan? What exactly are you looking for in those executive summaries?
I'm largely interested in understanding who the team is, understanding why a particular entrepreneur has decided to pursue the business that they're building. how did the entrepreneurs know each other? How did they come together? Why is it that this is a compelling group of people who are likely to be successful in whatever it is they're building? The second thing I'm looking for is a product that makes good sense. The reality is that the most successful businesses are ones that solve real problems. They say, "Oh, here's the problem that needs to be addressed, and here's how we're going to address it." And then the last thing that I'm looking for is that that a particular entrepreneur is trying to address a very big problem, that they're approaching a market that's massive. Because it turns out that these startups, the decks are stacked against startups. It's incredibly hard to get going. It's hard to convince people to buy whatever it is you're selling, et cetera. And so if you're starting with a market that's gigantic, you have a fighting chance of building a business that's maybe large. But if you're starting with a market that's relatively constrained to start with, it's very unlikely that you're going to get to a big scale.
And how many different companies have you funded?
I don't know the precise answer to that, but my guess is that I've funded about 25 businesses over the last, over the going on 15 years, and that feels about right to me.
And how you doing on these 25 companies?
Well, gee, the interesting thing about the venture business is that in any instance, you'll fund a set of companies that turn out to not work at all, and you'll likely lose all of your money. You'll fund some number of businesses that kind of do okay and make you a little bit of money, and then if you're lucky, you fund a company or two that is wildly successful. And so the best way to measure venture investors is sort of, how many of those really successful businesses have they hit, and how do they do in the ratio on these other things. And, luckily for me, in the last decade and a half, I've actually been relatively successful in that regard. And in particular, I funded an amazing company called Splunk, which is
there you go.
I'm sorry?
I said, there you go. I mean,
yeah, exactly.
That's the only one. That's the only one you need.
Yeah, I funded Splunk when it was just three guys and an idea, and at the time there was no such thing as big data to speak of. I mean, people were using data to get to business ideas, but Splunk really was one of the pioneers of here's a resource for understanding big data and pulling together value, et cetera. And I funded the company for at a valuation that was quite small, and then helped support these guys in building a big business, and today it's a multi-billion-dollar public company. So, if you can manage to fund a Splunk a decade, you're actually a pretty successful venture investor. And so, I have a set of companies now that are, if all goes well, my next Splunk. We'll see how that goes.
Okay, can you talk a little bit about your particular investment in Splunk? I mean, I don't necessarily have to reveal the dollar amount, but did you get partial ownership in a company? Is that way you did it through stock? Is that the way you participate with these companies?
Yeah, no. The way it works is, you get to meet up with entrepreneurs and say, hey, I'm interested in your business, and so for X number of millions of dollars, I'm gonna own a piece of your company. It's actually it's a public record. If you go and look at the S1, you can see that my firm owned something like 17% of the company when it went public. So, and I can tell you that I invested less than $10 million to own that much of the company. So it's if they were all that good, it'd be it'd be a great day at August Capital.
Exactly. Well, so did you? Are you in the stock for good? I mean, it had a run up over $100. And then it swooned up well under 50 to 30. Were you able to take some profits along the way, or you just get to keep this one until they put you in the ground?
Yeah, so I mean, partially what I would say is I still sit on the board of Splunk. Splunk's a public company, so I don't want to to provide
Disclose.
any
Okay.
information that's non-public. But the model ultimately for venture investors is, because we are getting in and buying big chunks of companies quite early, when they are ultimately public companies, when you get them to be public. They are ultimately, what you do is distribute those shares to your investors, right? The way venture capital works is that I raise a fund, and that fund is raised from institutions like universities and foundations and those sorts of things. I take that money, I invest in companies like Splunk, and when they're successful, then I distribute the shares or the cash that I get out of that company back to my investors. So the big question is sort of what's the time frame in which you do that, but at the end of the day, I will be in a position to distribute value back to my investors, and that's how they create gain for themselves in the venture industry.
And August Capital, and how long has that been around?
So the firm was funded in 1995, but there was a predecessor to August called Technology Venture Investors, or TVI, and TVI had been around for another dozen years before that. So the firm has actually been in the business going on something like 30 years. The partners at August have been investors in a number of sort of the earliest investors in a number of interesting businesses, starting with Microsoft. My partner, Dave Marquardt, was the only private investor in Microsoft. Sun, Seagate, Symantec, Xilinx, and more recently, Skype and Zulily and some other interesting businesses.
Wow. So it sounds like you guys have a pretty good track record going for yourselves.
Yeah, no, it's been a good run, and but you're only as good as your last great company. So we're busy working on the next set.
And I mean, sector related. I mean, did you mention Lilly? Did you mention Eli Lilly, or was that
No,
a?
no, yeah, no. Actually, I mentioned Zulily, which is probably as far from Eli Lilly as imaginable. It's a children's clothing online retailer.
Oh.
Although the beauty of Zulily is that it is the fastest. It's the company we funded that was fastest to $1 billion in sales. Sort of an astonishing rise of a company.
Okay, and so I imagine a lot of these businesses that are brought to you are predicated or based, through the internet, or some kind of venture along those lines. Is that where you're primarily seeing executive summaries from, and for people that are wanting to start companies?
Well, we invest as a firm across all of information technology. So we have companies that are doing storage and networking. We have historically invested in microprocessors. In fact, we were the first investors in a company called Atheros, which is now the Wi-Fi chip in pretty much everything. And then we do enterprise software that's sold into businesses, and then consumer-facing software. We were the first investors in Evite in the online invitation world, or like I said, Skype, etc. So a broad range of companies. We don't invest in biotech. We don't invest in medical. We tend not to invest in those areas because we tend not to have the expertise we need to say, oh yeah, this is definitely a drug that's going to work, or this is one's going to be able to change the nature of environmental policy or whatever.
How about the financial technology industry?
Yeah, I've invested in a number of companies that are in and around the financial space. I was the investor in the very first online payroll company, a company called PayCycle. A group of founders who were at Intuit and felt like it was time to build a service to manage some of what Intuit was doing, and they built this company called PayCycle. And it turned out that Intuit thought it was smart enough. They ultimately bought the company and bought the team back. I'm an investor in a really interesting company called Pay Near Me, which is a business that allows consumers who don't have bank accounts or don't have credit cards to still participate in the online economy. So they want to buy a Greyhound bus ticket. They go to Greyhound.com and they say, here's the bus ticket I want, etc. And then they go to 7-Eleven and they scan a barcode and they pay the $23 for their bus ticket, and the receipt from 7-Eleven is their bus ticket, or that sort of thing.
And they get a Slurpee for the bus ride.
Yeah, I mean, the good news for 7-Eleven is not only do you stop in the 7-Eleven store, you grab a Slurpee, you buy a bus ticket, and 7-Eleven gets a pretty good margin on all of those sales. So a great opportunity for 7-Eleven to interact with the consumers, and a much better opportunity for consumers who otherwise are sort of shut out of the digital economy.
Okay, one final question for you here, and obviously being venture capital, when you take the money in for these companies, you want to build up the company and eventually have them IPO so you can, redeem some of your cash. I mean, what do you think about? I mean, a lot of people say all these IPOs that are coming up are kind of symptomatic of a market top. Is that your opinion, or are people just buying these IPOs because all the big companies are buying back their stock and there's just really not enough supply in the market?
Yeah, I mean, if you look at the late 90s, I was, busy working with startups in the late 90s when people were worried about this. The companies that were being taken public in the late 90s had next to no revenue. They had they were great ideas, and many of those ideas have turned out to be good businesses, but at the time they were not good businesses. If you look at the companies that are going public now, the companies like Splunk or companies Lilly, companies like LinkedIn and Twitter and Facebook, the reality is that these are really good businesses, and that they're making millions of dollars, that they're grossing millions of dollars, that in many instances they're netting millions of dollars, and they're providing real value. And so, whether the valuations of those companies are higher than people think is rational, that may fluctuate. So, Facebook started out at $100 billion, traded down to $60 billion, but traded back up past $100 billion when Facebook then performed. Whereas a company like a Benzinga or a Groupon, started out at some, crazy high valuations, snuck down to $3, $4, $6 billion. Still pretty interesting and valuable companies, but more rational ratios. So, my view is that the companies that are going public now are great companies, and that there's an opportunity for buyers in the market to make good money on these companies because they're real companies, and they're not just being taken public on a wink and a prayer.
Yeah, excellent advice. Okay, we've had David Hornik on, investor at August Capital and author of VentureBlog.com, talking about the way that he analyzes new companies that are presented to him. I guess if you're listening to the show, you could say David, and you could submit a proposal to him, and he'll take a look at it. But thanks a lot for coming on today. Good luck with the markets, and we'll talk to you soon.
Thanks much. Bye.
Okay.